Hey guys, welcome to another Trade Genius podcast. Philip here with Bob. We got a really good one because there is a significant chance of a very large drop in the market, and we're not joking around. You're going to want to stay to the end of this video because we actually know what the range is likely to be, and we're going to tell you why that is. So stay tuned.
Trade Junior.
Hey, everybody. Phil, hey, I found this chart, and I know you're really into, tick data and market internals. Can you kind of explain this to everybody here, like you explained it to me, and why this is an important chart and what it tells us? A little prophecy here, I think.
Yeah, it looks like basically a bunch of zigzags, but if you look at the extremes on the bottom and where those dates are, okay, that was January 2022, beginning of this year, which was what? The top of the market, right? So at the very left there, you're seeing a bottom squiggle, okay? What those squiggles are telling us is that it's how much liquidity in the markets each day. Now, when it's at the bottom, there's no liquidity, and that's the reason for that is the market makers are basically not providing the liquidity, and so it's very easy for these markets to fall. Basically, without getting overly complicated, that's basically what it means. You'll notice too, as we went into August into September, we had another very low print. If you recall, the top of the last bear market rally was at the end of August. Okay, so these are very bearish indicators, and here we have the as low a print as we've seen up there with the top of the market going into January, and we have another print like that. So this is telling us that the market makers are running for the hills again, and that's not good for the market. So sometimes the simplest graphs can be the most powerful, and I think that's what we have here. So we're on definitely on a bear market drop alert here based on the liquidity levels in the market.
Yeah, the only thing I'll add to that, Phil, and that's coming in the face of seasonality, where everybody's kind of like pulling back and getting complacent and
Right.
Santa rally
Right.
and this thing could just hit us with a 2x4.
Yeah, it's you. I think this year you have to be careful about that Santa rally because it may. I think it's going to be. I think people will get left-footed this month, considering. I think it's going to be the trickiest December we've probably seen in quite a while. All right, Bob. The next chart was the seasonality, and the newsletter we talk about seasonality, and for the most part, and this is a unique year in terms of seasonality because you have a Dem president first term. Dem president second year midterm. Okay, so there's all these different years that coincide. So typically that tells us that it's bullish into the end of December. However, not in bear markets, and that's what we have. We have a bear market, and you'll notice the bottom line there, that brownish colored chart is represents what happens in December for a bear market. So it kind of bucks, most people look at the seasonality chart and they say, oh, well, we're up in December, so let's get long. But this is telling you quite a different story. So it's another piece of the pie or puzzle that tells you that we have to be careful going into the end of the month. And then you posted this one, which I thought was very powerful. And it's basically a fractal or a comparison to the 2008 bear market.
Yeah, and a lot of people have been trying to figure out what fractal works, and fractals are obviously just some of it's parlor game stuff, but you learn things from this, and we're kind of repeating the same mistakes, but with different asset classes. And this one's been just true. And this caught my eye after we found these other charts that you and I were looking at earlier this week and this weekend, and it's like alarm bells are going off. Said, man, this. And you've always said it too. For people who trade with us, we have a room, a VIP room that we actually could talk to each other and talk to our subscribers. And everybody was just like, okay, we hit a level, is it over? Hit a level, it's over. And then we're like, we haven't had the flush yet. You need to have a scare the children move, and we haven't had that yet. And I think if this holds true, that's a scare the children move. This is like the September, October move that we had in 2008. Now I traded that, Phil, you traded that, and that was heart-wrenching, trading in terms of being able to, people just saw their lives passing in front of their eyes on this. And I'm fearful that people are pretty beat down, and when they see this thing move going into next year, pretty scary. And I think it may scare the hell out of Jerome Powell too.
I agree, and that's where they can talk all they want about how they're going to perform into 2023 as far as cutting or not cutting or staying hawkish. But if the market does that, we're going to get a pause real quick, and you're going to get cuts faster than than they were anticipating. And it's all if you notice too, Bob, what they always say at every one of their pressers or whatever is, well, we have to be dependent on the data, right? So it always gives them an out. They can say, well, we told you guys we'd have to, dependent on the data, and the data is so horrible that we're going to have to start cutting rates sooner than we thought. We think we'll feel it's appropriate to do so. So the other chart was the inflation chart, and I thought this was, and we're showing this because the Fed's been hawkish, and they continue to be hawkish, and they continue to keep hitting the pivot brothers on the head, right? The pivot bros in the market just keep trying to bid up this market every time they think they sniff a pivot out. But this is, I think what they're doing is they're looking at the inflation of the 70s, and they realize how persistent it was and how long it took to really come down. I mean, if you look at where we're at now, relatively speaking, this would be another year and a half that they're fighting this inflation monster. So unless the market really pukes up, I think they're going to try to continue that course of that plus 5% Fed funds rate. And we'll see, they might, we'll probably go down the quarter point raises, but, they're going to try to persist through next year as much as they can, because I think they're really afraid that it's just going to be very sticky inflation. So this is why the Fed is taking the approach that they have. The next chart I wanted to show you guys too was the liquidity chart. So we have the chart we spoke about in the beginning is we'll show that next, but you want to temper all of this stuff with what they're really doing behind the scenes. And as you guys, for our longer time viewers, you've seen this chart a number of times. And the blue is essentially the fuel in the market, and it's provided by a combination of the Fed and the Treasury, and how much the banks are parking at the Federal Reserve overnight or not parking. If they're not parking, then they're in the stock market. So on net, we've actually been trending up. So while we think things are looking pretty terrible, nothing's in a straight line. And this sooner or later is going to have to start coming down too, to really start the ball rolling on that next drop. And if you guys look toward the middle of the chart, you can notice there was a significant drop in the liquidity that's available to the markets going into from April to May. And that caused basically the markets to go from a high of around 4,500 down to a low of around 3,600. So they can drop this market very, very quickly. And then you notice on net, we're kind of sideways from that era of that initial drop. Personally, I think they were like, wow, this market really does not stay up at all without us. And we got to be careful about how quickly we drop this thing. So I think they gyrated, but on net, we haven't really gone down a whole lot since the middle of the year for the net liquidity that's available to the market. Now you can see the stock market will gyrate around overbought and oversold as represented by that blue line. And you'll notice that blue line over on the right is starting to get into that zone where we do get bear market rallies from. So Monday could be red, but then we will probably see a snapback rally at some point during this coming week. And the pivot bros will be back saying, yep, we're going to go back up. It's a higher low. Probably not true, because unless this liquidity starts skyrocketing higher, this market ain't going up. And there's enough things here that we're going to show you, especially on this next slide, and Bob's going to tell you all about it, where you should be very concerned and prepared for what's next. And that's going to be this chart. Take it away, Bob.
Yeah, people put your seatbelts on. So after the Fed comes people like JP Morgan that set market conditions. And what they do every quarter is they put a collar together where they sell, they buy puts, and then they sell puts underneath it. And then they also sell calls to pay for the puts. And all well and good for them if you don't stay above the sold call level, where they basically have unlimited risk, or they're probably behind the scenes buying futures. And if you notice, when they put this trade on, at the bottom there is where support is from earlier in the year. And how this works is JP Morgan last October, they drove it down to the sold put level. Okay, they're not doing this for their health. They're doing this to maximize profit. and the bear market rally was so strong that they only have 2 weeks left to drive this thing back down into their profit zone. So my view on this is that it will be difficult to stay above the 38.85 area, which where we are right now. Okay, because that puts JP Morgan at risk, and they have a lot of money. And if they want to drive for profit, they have to get below that next level, and that is 33. It is an eye chart for me.
33.90.
33.90 area, which is, we've been talking about that price in the room for a while.
Mm-hmm.
That's a best case scenario, I think.
Mm-hmm.
The one that just will make you start curling up in a ball is, and if you're long the market, is that if we push down to that 28.60 level, which where they have their sold puts. So my point of view is, worst case scenario, 25% 2-week drop. Can that happen? Well, look at the fractal that we showed you for 2008. We had big moves like that before. Okay, so it's not out of the woods. There's nobody in this market right now. People are packing up to go places. And just remember, we've had a red year. So there's mark-to-market issues for hedge funds and institutions. There's tax loss selling for them. There's no good guy coming into the market where people made money somewhere else and they're going to start pumping into 2023. And we're going into recession. So it sets the stage where something crazy like this could happen. But my personal view is, I think we'll probably end up between that 28.50 and the 33.90 area. And I don't know when JP Morgan will start rolling this. They'll probably start rolling this thing next week into the last week of the year. So that may hinder the impact a little bit, but this is not bullish at all. And I just want to point out to people with more money than you and I that are doing derivatives could drive the market in the direction they want to go. In October, they got what they wanted. And December, they're likely to get paid again. So stay tuned. And 3,400 from 3,800 is not a big move down. We almost did that from Tuesday to Friday of last week. So Phil, I'll throw it back to you for any final thoughts on that.
I think that this is hugely important, because guess what happened the last time they had their collar on? we went to the bottom of the collar. And so I think that, like you said, all the ingredients are there. Going into this second quarter of next year, very well could see 28.60. And if we all have our heads wrapped around that, we'll do very well. We won't be buying into this market in the wrong spot, or we'll be getting protection to cover us for a move down there. So, yeah.
Well, I think we'll see pretty quickly.
Yep. All right, guys. Well, we hope that helps. Please let us know your thoughts on this information we presented to you guys. We'd love to hear the feedback. Otherwise, please hit like and subscribe. Thank you so much for watching, and we'll see you on the next one. Take care.
Trade Genius.